I'm going to touch very briefly on the thorny topic of the general election. I'll then touch even more briefly on the even thornier topic of Brexit, and then just look at some key themes for 2020 and beyond, while hopefully setting the scene for the following speakers and not trampling all over their patch. Disclaimer. Slightly different one, but the principles are the same. So they're the four topics. So to start off with, on the general election, who's that? Good. The unknown Prime Minister, of course, Andrew Bonar, and just to explain, Conservative Prime Minister in the 1920s, and if you're Boris Johnson, he's the one person that you're probably more desperate to beat than Jeremy Corbyn, because he is the shortest reigning Prime Minister in modern times. And if Boris gets turfed out before the end of February, he's going to take this man's mantle. So that's the one thing that he definitely does, one record he does not wish to break. So there's Bonar, 1922 to 23. Unfortunately, the reason that he had to stand down was due to very, very serious ill health. But that is the one person I think Boris is more desperate to beat than anybody else. Now, more seriously, I've looked at all the general elections going back to the early 1960s. Since the inception of the FTSE All-Share in the early 60s, that's 15 general elections now, 9 prime ministers. And again, we must accept that past performance is no guide for the future. But there are some interesting trends. Intriguingly, a change of government isn't always seen as a bad thing by the financial markets. Normally, they feed off certainty, and probably I intuitively believe they would prefer an incumbent, which was the case until relatively recently. Now, size of majority has not made any difference at all to how the FTSE All-Share has performed, although generally speaking, and please note this is not an expression of personal preference on behalf of my employer or anybody else. The stock market, it's just a statement of fact. The stock market does seem to prefer, on balance, a Conservative government, and the data backs it up. But it's not a statement of preference. And just in case you're wondering, my constituency is Brighton Pavilion, so my MP is Caroline Lucas, the only Green MP in the country, so I'm a complete outlier in terms of where I live as far as the broader political discourse is concerned. So what happens when an incumbent wins? Well, strangely enough, it actually does a little bit worse than if there's a change of government. Now, I know you'll all have your personal preferences right now for who you would like to win, whichever colour it happens to be, whichever leader it happens to be. But oddly enough, historically speaking, it hasn't made an awfully big deal when the incumbent party has lost. This time, you may believe it will be different given some of the policy statements that have been made, but historically, it hasn't been such a big deal, certainly over a full term. Size of majority is one. I mean, in many ways, we feel that we've been tortured by minority or by coalition governments which haven't been able to force through the legislation that they want to try and break some of the log jams that have occurred. And intuitively you think, oh, well, big majority, maybe the market likes the certainty that provides. Again, actually, yes, we've got a thumping great majority here for Tony Blair, and the market did well. But equally, he got another thumping majority next time around and did very badly because that copped an awful lot of the bursting of the TMT bubble. Margaret Thatcher, whacking great majority there. Market did very well. But again, there are some very fragile governments down here, and actually the market performed very strongly over the first year of a government. And in some cases, if you look back to Harold Wilson or Ted Heath, you have some very, very fractious minorities when the government did when the All-Share did relatively well. And the same over, again, a full term in office. Big majority does not necessarily mean bad performance. Small majority does not necessarily mean poor performance. There is no rule of thumb there. So I know we'll all be poring over who's won what, and whether there's a majority or not. It might not be the end of the world if there isn't one. And this is just the colour scheme. 4 of the 5 best performing prime ministers have been blues. 4 of the 5 worst performing prime ministers in stock market terms have been reds. But again, there are clearly other circumstances at work here. Gordon Brown copped the great financial crisis. Harold Wilson copped the tail end of the oil shock, for example. Theresa May copped Brexit. Tony Blair there again got the TMT bursting of the bubble in the middle. So there are other issues at work. It's not just down to the colour of the rosette of the person who's going to be walking into number 10 Downing Street, one hopes, one assumes, on the 13th of October. There are going to be clearly other factors at work. Economics, inflation, there are multiple other considerations. It's not just down to politics. Important as it may well be in the short term, in the long run, there's that great quote from Warren Buffett. In the 20th century, the United States of America suffered 2 world wars, multiple outbreaks of flu, the impeachment of a president, several other catastrophes, and the Dow went from 66 to 11,000. So you will clearly get short-term volatility, but again, don't get too hung up necessarily on some of the finer points of detail. This is just my best guess for what might happen if we get, a Labour Party win, a Conservative win, or this at the right-hand side is designed to sort of represent a coalition. Given the negative press that's been attached to some of the Labour Party's policies, you would expect that the equity market would initially at least take fright, whereas it may well welcome with relief the possibility of a break in the Brexit logjam as well. So long as it doesn't get the feared hard Brexit, there'll be the working assumption that there is an attempt to get a deal, but that clearly isn't guaranteed because we still have the transition period running to December 2020. And if there is no satisfactory deal reached, so I suspect, for example, with sterling, you get an initial relief rally, but people will then think, okay, we've got the next hurdle, which is December 2020. And a coalition and a return to the logjam that we've had for the last 3 years, not probably desperately good for equities. Gilt yields. I know that the Tories didn't go absolutely nuts with the spending plans when they announced their manifesto over the weekend, but there is still a sense that the taps are being turned on. Clearly, in the case of Labour, that's very much the case, and you'd expect that the coalition would extract some sort of promises on spending. Whether it's the end of austerity or not, it certainly feels as if there is going to be a gentle increase in spending, or if not a very great big one. Intuitively, you would feel that's not necessarily brilliant for gilt yields, particularly with the 10-year down at 0.75%. And the pound, probably the ultimate Geiger counter in some ways, because with the Bank of England sat on £435 billion worth of gilts, you could argue that the bond market isn't necessarily as perhaps well-functioning as you would like to think. Normally, if investors are unhappy with the government or happy with the government, they will charge it less or more to borrow. Well, the Bank of England's sort of trying to short-circuit that process at the moment. So maybe gilt yields won't be the real indicator. It'll be sterling. And that's my rough guess. But again, I would say, and I say this a lot when I'm on the TV and the radio, people say, what's the market going to do on Brexit Day? Well, I say, well, you tell me where the market is on Brexit Day, and then I'll give you a pretty good idea. Because if it's the FTSE 100 is at 8,000, I can guarantee it'll behave differently from if it's at 4,000. So a lot of it is down to the price and the level of the day, but that's assuming we are roughly where we are now. So, anyone who isn't confused doesn't understand the situation. Edward R. Murrow, legendary American broadcaster, and it clearly isn't a particularly clear situation either way. Just in terms of the short-term politics, I'm desperately trying not to get too hung up on that, and certainly second-guessing investments or strategic portfolio decisions at the back of it is probably fraught with risk. We're also more, in a bigger picture terms, still looking at markets wrestling with, are we going to get decent growth, a little bit of outbreak of inflation at long last after a slightly tepid 10-year upcycle, or is the West slowly but surely sliding into a sort of Japanese-style debt deflation? And I get research coming in all the time arguing very, very strongly for both of those diametrically opposing camps. And if one prevails at the expense of the other, then you will possibly need a different portfolio solution to try to see your way through to the other end. At the moment, I think, given that we've had a pretty good run in risk assets this year, albeit with a wobble over the summer, there is clearly faith in a US-China trade solution, and there is clearly faith in central banks pulling out all the stops to make sure that the growth wagon stays firmly on the road. This chart here just looks from cbrates.com, just looks at the number of individual central bank decisions to raise interest rates, and the line is the number to cut them. And when we were here a year ago, the consensus was, well, the Fed had just put through three rate rises. There will be a boatload more coming this year, 3 or 4 for certain, with other central banks being dragged along for the ride. Well, that clearly hasn't happened. We've had a crescendo of interest rate cuts, not interest rate increases, as central banks have responded to their concerns over global trade. You've seen the CPB data going negative for 3 or 4 straight months now. That's global trade volume. American freight volumes have been down year on year for 11 straight months, and that's beginning to filter into things like heavy truck demand. So you are starting to see some genuine impact on the real economy, and perhaps that's why the Fed has responded, in addition to being browbeaten by the incumbent of the White House. But you've seen a big move towards interest rate cuts and looser policy at a time when we're also maybe moving towards looser fiscal policy, which is why the growth narrative at the moment feels like it might be slightly winning. And again, this is the US Federal Reserve. That's the interest rate trajectory since January 15. This is possibly even more interesting. This is the size of its balance sheet. Now, the Fed had been sterilizing quantitative easing at a rate of up to $50 billion a month. It stopped that last Christmas, and it's actually now begun to expand its balance sheet at an incredibly rapid rate. And this is because of its intervention in the interbank lending markets in the US that looked like they were slightly breaking down in September, October, when overnight borrowing rates reached around 10% in the States. Now, I can only assume, and the Fed has just maintained a very discreet silence on this, that somebody somewhere, either a bank or a real estate investment trust, who was very heavily leaning on the overnight funding markets, found itself in a bit of trouble, and the Fed has stepped in. So you do worry a little bit about that, but for the moment, the markets are taking the positive from this, which is the central banks have got our back. They're going to make sure that there is no downturn problem and that we will get growth. And if anything, they will continue to strive to create that come what may. What's the counter-argument? Well, one of the dangers of central bank policies at the moment is that it does seem to be doing some damage to the financials, and this is kind of the Japanification argument. So this is the global S&P 1200 banks index, or that's the red line there, and that's the global S&P 1200, and banks have just not enjoyed the last decade at all. And although banking is in theory relatively simple, you raise money at one interest rate, lend it to somebody else at a higher interest rate, pocket the difference, then get your money back at the end. Obviously, they make it look a lot more complicated than that. But what you really need, therefore, as a bank, given that very simple model, is you need positive interest rates, a steep yield curve, and wide credit spreads. And you have none of those three things available today. So it's tough to be a bank right now, and you can see that in the way in which these things are performing. And this is the Japan situation. So if you really want to look at a debt deflation writ large, then we all go back to Japan, because its stock market peaked on the 31st of December 1989 at around 39,000, and it's at 20-odd thousand now, 30 years later, and it's still finding life pretty hard. And the Japanese economy it's hanging in there. And there's lots of good things I can say about Japanese equities, but bears will always hold up Japan as being economically the place where no central banker wants to go. And as you can see, this is what it did to Japanese banks. Their share prices are down 90% from the peak. And within reason, they slavishly follow the yield curve lower. So as the Japanese central bank got stuck into zero interest rate policies, negative interest rate policies, quantitative easing, qualitative quantitative easing, as the gap between the 10-year interest rate and the 2-year interest rate gradually squeezed up, that has compromised banks' ability to earn a margin from pocketing the difference, and that's what's happened to Japanese banking stocks as a result. Now, this fiddly chart here is the same Japanese banking index since the start of 1988, 2 years before the bubble burst, and this is the FTSE All-Share Banks Index since 2006, 2 years before its bubble burst, and that's then just run according to the same timescale. So the FTSE All-Share Banks Index is down about 60% right now. So we'll see. Now, what's obviously interesting here is you've got some whacking great rallies. And there's no doubt about it. We can all argue that UK banks are cheap stocks because they're trading at discounts to book value. In some cases, they're offering decent yields. And I suspect that if there is ever a real market move for inflation, growth, and dare one say it, value stocks, which are out in the freezer still, then I would imagine banks would be a pretty interesting way of seeing whether that market is really thinking that way, because you've got some ripping rallies in Japan, and this one was an absolute doozy, 250% from there to there. So that, you know, that's because Japanese banks were trading at discounts to book and looked interesting to value hunters. So if the world really does start to stuff a Japanification, or the West does, the banks may well be one way in which we can tell that. So Japan is interesting because in 1990, nearly all of the world's biggest stocks by market cap were Japanese. In the 2000s, they were nearly all tech stocks and telecom stocks. In 2010, they were nearly all China-related commodity plays. Right now, they're pretty much all tech stocks. So the danger here is that we've just looked at what happened to Japan. Well, it went down, you know, it's still 30 or 40% below where it was back in 1990 when this snapshot was taken. So what seemed blindingly obvious from the 1st of January 1990, that Japan was going to take over the world, and Michael Crichton even wrote Rising Sun, the book about it, about how corporate Japan was going to hollow out corporate America. Japanese stocks have basically not been a great investment ever since. It took the Nasdaq 15 years to get back to where it was at the start of 2000, when that bubble burst, and the Chinese story has lost some of its luster this year. Oil hasn't got back anywhere near $147 a barrel, and these stocks haven't been fantastic. They've not been dreadful, but they've not been brilliant. So while it's extremely tempting to think that what we know now low growth, low interest rates, therefore buy long duration assets that have got secular pricing power and secular growth, look good now. If we did get inflation, if we did get growth, because either Christine Lagarde has hit the print button, or a government or the Democratic Party has hit the print button, if we did get inflation, everything that's worked for the last 10 years is going to look like poop by comparison to good old-fashioned value and cyclicals. So just because it's worked for the last 10 years doesn't necessarily mean that it's absolutely certainty for the next 10. So do beware of recency bias, and Japan is a great example of that. I've used this quote before, but it's a great one. And this, again, refers to the danger that you can get by being sucked into optimism and euphoria. Again, buying what is obvious is rarely very profitable. It might be in the short term, but in the long run, it tends to get you into trouble. And this is, this guy died a billionaire, so he's a lot better at this than I am. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Now, those of you who were here last year will remember that I just did a little grid, not necessarily based on how the asset classes had performed, but because I've got, Charles keeps me busy. I've got several jobs at AJ Bell. I do the videos and the blogs, which hopefully you read, but I also deal with questions from the broadcast and the print media, as well as your questions. And I based this last year on things that nobody asked me about at all. Pessimism. Nobody was interested. And I based it on things that everybody was, I had a constant stream of questions about all the way through the year. Euphoria. So if you look at where we were a year ago, where were people, basically giving up all hope? Abandon hope, all you enter here. Real estate investment trusts, UK equities, gold, emerging markets. Well, overall, actually, I know most things have gone up this year, helped by our friends, the central banks, but they didn't completely disgrace themselves. In fact, quite the opposite. Junior gold miners and gold mines were about the best performing lot on the list, and I didn't get one question about them last year. And when I did write about them, I got snorted at. So, skepticism, banks and financials, nobody really wanted to know. Japanese equities, nobody wanted to know. European equities, nobody wanted to know. And everybody was telling me that the US government bond bull run was determined, it was desperately going to end. Where people were excited, well, in fairness, this has worked out rather well. This is total returns in sterling, by the way. Lots of people were telling me that oil was going up very strongly last year because OPEC was there to control the market. Well, that hasn't panned out so good. And FANG stocks obviously were very popular a year ago. They had a horrible first 2 quarters of the year, but have come back strongly since. But intriguingly, the things that nobody wanted to know about, either didn't ask me or when I talked about them, they said, I've got a really good idea if you have a think about this. They didn't want to know. Well, they haven't embarrassed themselves anyway. So where are we on this year? It's a little bit like, if those who remember Alan Freeman doing the top of the pops things, he'll move things going up and things going down the charts, which is the arrows. Real estate investment trusts, nobody's still interested. UK equities, various reasons we've discussed earlier, Brexit, general election, nobody's still interested, but there's yield, lots of value, I think, to be found, certainly down the market cap levels, but I'll defer to the experts there. Emerging markets have probably slipped down a little bit. Oil's gone from there to there. And income and value investing, we've got some experts to talk about this, but they're finding life still pretty hard. It's a struggle to get people to move away from what's worked brilliantly for the last 10 years, investing for growth, investing for quality, and investing for momentum. Optimism, I know WeWork's had a bit of a strange year, but overall, unicorn equities, I still get lots of questions about them. Japan's, I deliberated as to leave it there or not, but it's had a decent year. European equities, because of Signor Draghi getting the money printing pressures are going, less skepticism there. And then still massive enthusiasm for US equities, loads of questions about FANG and tech stocks. And I've had bucketfuls of questions about cannabis and space stocks nearly all year long. And I'm maybe, but all I'm going to say is, look, cannabis is known as weed, so it's not hard to grow, ladies and gentlemen. And at a time when there's limitless amounts of money out there, I don't think anybody growing weed is necessarily going to find it desperately easy to make a profit. There may be other ways of doing it, medicinal, intellectual property, but just growing it, I could do it in my back garden. So I'm not, if I was allowed, I'm not convinced that that is necessarily going to be a winner. And again, just the number of questions I've got on it has been unbelievable relative to the number of questions I've had on some of these things down here. So again, if I was looking to sort of, after a 10-year run, how would I look at the world? I mean, one of the things, again, you've always got to think about risk as well as reward. Something's likely to crawl out of the woodwork at some stage, just as it did to unseat Japanese equities, as it did to unseat tech stocks, as it did to unseat China players. And one way in which you can protect the downside is try and seek out the unloved and seek out some value. we certainly think, this issue of liquidity has been raised constantly in the fund world and the individual equity world. It's going to be an issue that we all need to be aware of. And if any one of these scenarios, ultimately, pricing power is going to be incredibly important, particularly if we get inflation. Bernard Arnault isn't spending $18 billion on Tiffany for the good of his health. He clearly thinks there's a brand there. He clearly thinks that, diamonds is something where you can still, in the end, exercise perhaps some pricing power, because we still have all three eventualities awaiting us. Central banks don't know, or they wouldn't have done a massive policy pivot from 12 months ago. We could still get inflation. If Elizabeth Warren gets in, she's going to bang fracking. I've got a former UBS colleague here who will tell me an awful lot about what that means to the dynamics of the oil market. But if you look at when oil goes up 50% year on year, it generally puts the brakes on the economy. And if it goes up 100% year on year, you've got a pretty good chance of a recession. So there's always funny things can come out of the woodwork. We've got all three possible scenarios. So I wouldn't put all of your chips on one, as again, that 1990, 2000, 2010, 2000, and so on example offers. Zero, bang on. So thank you very much for your time. I look forward to hosting the panel session at the end.